My reading notes for Secrets of Sand Hill Road, Venture Capital and How to Get It by Scott Kupor and Eric Ries. Whether you're trying to get a new company off the ground or scale an existing business to the next level, you need to understand how venture capitalists think. In Secrets of Sand Hill Road, Kupor explains exactly how VCs decide where and how much to invest, and how entrepreneurs can get the best possible deal and make the most of their relationships with VCs. It's important to set your expectations of board members up front. How do you want your meeting ran? CEO needs to know if board members are reaching out to employees. Board member maintain legal liability safety by performing duty of care to the common shareholders. Must stay reasonably informed of what is going on. Must not self-deal or seek to enrich themselves. VCs must balance loyalty to LPs in the company. Chinese wall equal to formal process where one GPE a VC firm will not share information from one board with the GPE on other board. Must act in the long-term common shared interest of the common shareholders. Preferred shareholder rights are contractual nature. If suing board, have to show that the process was bad, not the judgment. For example, dual fiduciary getting benefit does not automatically compromise them, can require them to read this book and enter in minutes. Court asks, was it a fair process and a fair price? When the company is doing poorly financially, it's necessary to recapitalize. Often, the first attempt is obtaining bridge financing. Generally as a cash infusion from existing investors as a convertible note under terms of the last round of financing. Restarts the journey toward success. Sometimes have to retroactively lower liquidation preferences to attract new investors, more money. Can reverse split by converting their preferred shares to common. Sometimes much as 10-1 provide. Lower valuation to restate to current value of company. Awarding new money too close to a deal looks fishy. Good idea to have a banker show deal to a bunch of no's. MIP equal to management incentive plan. Plan to pay monument to pray for a sale. Needs to align W common shareholder interests. Warn Act equal to have to give advance warning of shutdown. Generally 60 days. Faltering company provision equal to exception if trying to get financing and notice of layoffs can. Jeopardize. Positive exit equal to companies get bought not sold. Buyers will generally want seller to indemnity them against certain things. Revlon standard equal to while the board has no obligation to sell the company. But if it does go down that path, it must seek to maximize the value of the common stock. Should one, reach out to multiple potential acquirers with the help of bankers when possible. 2. Consider other potential paths forward. For example, financing authority to maintain. Autonomy. 3. Consider incorporating a go-shop provision into an offer they receive from an acquirer to permit for competing bids. 4. Document. A well-vetted process to show the board considered these. Overview of the IPO equal to reasons to go public. Raise capital equal to becoming less important. Can get hundreds of millions or billions privately. Branding equal to used to be a bigger event. Liquidity equal to ability of employees to convert their ownership shares to cash. Hard to sell shares of private company. Customer credibility. MA currency equal to all product. Has a life cycle. Might need to build or acquire new technologies. Stock market is a daily price of worth. Process, beauty contest, or bake-off. 1. Pick a bank to underwrite. Research analysts who will publish info on the company. Interact with institutional buyers frequently. Will do thesis on company. Consider the strength of their trading desk, generally co-underwriters. 2. Roadshow equal to 7 to 10 days of meetings with investors. 3. Confidential filings with the SEC. SEC want to minimize hype. 4. Prospectus becomes publicity, available. 5. Building the book equal to talking to institutional investors to gauge invest and price. 6. Final SEC prospectus approval. Pricing the IPO equal to very difficult. Generally leaves one of the partners unhappy. Raise the most money with the least dilution. Very bad if goes down first day. Negative sentimental can ease self-fulfilling. 8. Green shoe process equal to investment bank may buy, sell to stabilize price for 30 days. VC's founders typically can't sell for MOS longer on BOD. Secondary offering of shares equal to orchestrate a secondary offering. Generally to existing institutional shareholders. Shares owned by someone else, not newly issued. Proceeds are to the holders of the shares, not the company. Can help get shares into friendly hands. As CEO, you have a new set of bosses, governance rules, and scorecard. Cap table typically 60% for founders, 10% for employees, 5% advisors, 1%, 5%, 25% investors. On pre-money valuation, equal to typically want to give up 10 to 15%. If you're great, Normal 20 to 25%, worst case 30 to 35%. How to build a software company with no money, by Dan Martell on YouTube. Equity splits have to motivate the futures of the participants, people who are full-time and all in, not contractors.